Good evening. This is Ken Long at Tortoise Capital with a review of the weekend trading report for February 11th, 2017. The market is in bullish, quiet conditions once more. On an annual basis, using weekly RSI 14, we just moved into overbought conditions with a score of 72 out of 100. That's the first time in a couple years that's happened. On a 10-day basis, using the 10-day NDX, we are also overbought with a score of 95 out of 100. So by definition, we've had quite an extraordinary move here in the last 3 to 4 weeks. Looking at the market mosaic, price with respect to the 200-day moving average is green bullish at 7.69. The slope of the 50 moving average is white bullish at 0.48. We have not achieved really a strong short-term trend yet, with ADX 14 only registering neutral, so there is still room for this currently beginning leg to go further. The risk index is the 30-period moving average of the VIX divided by the 10. The boundary between risk on and risk off is 1.0. The current reading is 1.022, so we are into risk on, where we've been for almost 60 days now, as you can see, looking at the histogram of the last 90 days. When we take that score of 1.022, compare it to the last 5,000 trading days, find the average and standard deviation, that lets us compute the risk Z score, which is 0.15, and that's the histogram that you see here. As long as that line is in the green, that is a condition that is favorable in terms of volatility for the short-term market moves. This has lasted such a long time that there is pressure building up for a recovery or a reversal, and with the market overbought both annually and short-term, the time is becoming more ripe. That doesn't mean you should take a short position, but what it means is you should be concerned about protecting the gains of the last 60 days, identifying the any stop and reversal moves that you want to play, and also stalking weaker sectors, which in our line of reasoning are the ones that are most likely to suffer should we see a short-term market reversal, as people try to lock in the outsized gains of the last 2 months. In blended month rebalancing, the reevaluation is due on or about 1 March. You can see here the current leaders in the clubhouse. The financials have been doing very well. The small caps have been outperforming the large caps and continue to do so. These are the current leaders as of Friday's close of business. You can see it's still mostly the same leaders, although GUR, the European small cap, is starting to sneak its way in. And then you can see the leaders in the other portfolio universes here, with Goldman Sachs, JP Morgan, American Express being the top 3 out of 5 in the Dow, as the financial sector continues to rock. ETF2, the theoretical exposure remains at 100%, and the model will be at 100%. Quick look at the blended monthly rebalancing portfolios in further detail. Again, you can see dominated by the U.S. and by the financial sectors and the small caps. That continues to lead the way. Materials and the bricks are coming along nicely also. In ETF Max, some things to look at here in the metals and mining area: uranium, copper. You can play that more broadly with XME as a metals and mining ETF. Also, China materials, select metals and mining. Here's more copper. And, copper is considered a bellwether for economic activity downstream, so that bodes well for the market longer term also. So this is clearly a market that's trying to power through and build on the base that's been established in the last 2 months. Shows no sign of slacking. The only negative really is the fact that it's been overbought for so long on both short-term and long-term. In the S&P 500, you've got some winning candidates here in the financial sectors like Lincoln National and regionals. You see some of the tech starting to give back a little bit here with NVIDIA and Western Digital, both suffering larger than average pullbacks despite having some really powerful moves over 3 and 6 months. In the market health check, these vertical blue lines represent 10, 20, and 30 days worth of look back, 40, 50, and 60 here. The red lines horizontally are support levels that used to be resistance levels, but which are holding for now. We had almost a 50-day, maybe 40-day sideways quiet channel consolidating here as you see the Z3 Bollinger Bands pinch to a very tight level. And we got a breakout in here which is held. And now in the Wednesday, Thursday, and Friday of last week, market has started to move from out of this base, voting upwards. We can see another 5% bump from this price level, given the length of the last move and the length of the base implies a potential 5% upside. The two support levels at 226.5 and 224 are providing the base of that support. Should that break, we'd then be looking at coming back down here to around 218, and then at the 200-day moving average around 216. So these support levels, when they violate or get violated, become price ladders on the way down. I want you to notice the slope of the 30-period moving average is this sine wave, which peaked right here and then has decayed as this market was getting sideways. That slope of that 30 remained positive. It's positive as long as it stays above this zero line on the left-hand index scale. And so it pulled back into historical norms for grinding upwards bulls, and now over the last 14, 15 days has started to vote upward. So this is what we mean by having room to grow for another 5% because of the length of time spent in this base without failing any further. The market has digested this last move, the initial Trump bump, and now is moving out for stage 2 or the leg 2 upward move. So we will be prepared for that contingency. In ETF2, you can see all 10 indexes are on a buy signal, keeping us at 100% invested, 0% cash in the allocation model. The S&P at 51 strength is better than the global EFA at 48. Inside the U.S., it's mid caps at 56, small caps 55, tech at 55, large caps at 51. All of those doing better than the rest of the most of the rest of the world. Only Latin America is starting to recover some of its strength from the past couple years. Two strongest sectors I'm going to count as mid caps and small caps, but ILF is pushing its way back into the top. And then the two weakest sectors, EFA and IEV. Inside the sector spiders, it's financials clear and away the strongest, followed by technology and materials. In the world market model, everything in the U.S. is above average with mid-cap value and small-cap growth exceptionally strong. Commodities and oil making a nice rebound. The defensive plays, the alternative asset classes like gold, silver, treasuries, and bonds, and U.S. real estate lagging. Inside Asia Pacific, Japan, Asia less Japan, thriving. Real strength except for Philippines and Vietnam. Latin America and Brazil and Canada have rejoined the green. Mexico is lagging a little bit, although there has been a reasonable move in the peso now that the Trump scaremongering perhaps has been digested. That's been a nice overreaction play in the last couple of weeks. Everything Europe is kind of mixed between slightly above and slightly below average. And you can see that in the finance sector, both U.S. and globally, is clear leadership role. You see the same trends reflected in ETF 2 top 30s. Excuse me, with oil and gas, metals and mining, and banking dominating all the way across the board. Those that are in green under strength and white under consistency are ones that have more recently come back up to the top. So you see Brazil, oil, another oil, Latin America, MLP infrastructure, and the commodity index in Canada, also a strong commodity base. So we're seeing resumption in the commodities. I think that is so cyclical on a swing basis that I still think there's room to grow in that. And so I will be trading those with core and turbo positions, looking to leverage the intraday moves when they are exceeding the returns of the broad equities. So that's the core and turbo technique. In the Dow 30, it's Goldman Sachs. Apple has rebounded all the way back up to the top of the stack. It used to suffer down here at the bottom, but it has now rejoined the top 5. So notice Goldman, JP Morgan, American Express all have resumed a leadership position. Laggards down here: Pfizer, Coke, GE, J&J, ExxonMobil, and Walmart. For you value seekers, we're going to look at the daily report now. Just Intel on channeling overreaction and a handful of auto framers. You can notice here in the ADX that the bulls are in charge. The trending line of ADX has come down and bottomed out below 15. Has crossed back above 15 with bulls in charge. That's the kind of health check you get when at the start of bull runs rather than at the end. So there's room for that upward trend to continue to unfold. Just a couple, again, the channelings here in Intel, just a couple on the auto framer that test out well, and 3 signals on the frog quality number. ETF 30 basically showing the same kind of deal, although a lot more frog quality numbers looking favorable, and only the VIX testing out well on the auto framer. This is still a time to be playing XIV. I think core and turbo. But being prepared for one-day system shocks and volatility. A handful of symbols here test out well on the auto framer, including Microsoft and Intel, ExxonMobil, and then in the regression line fractal framework. These in the green are symbols that are the most numbers of their own ATRs below their long-term fair value. So I look at these at the top shelf in green as favorable reward to risk ratios on value plays, and I look to frame them accordingly. And then the risk to reward ratio in terms of ATRs that are available on daily charts is indicated in the RR column. Conversely, those in the red in the bottom shelf are the most numbers of ATRs above their own RL270 or the long-term fair value. And so these tend to be relative strength leaders, and there can still be more room to go in these. It's just that they've had extraordinary moves and have already had a strong move upward, and so I tend to be more careful on how I play these, usually shorter term. I like to look for turnaround value plays in the top shelf, and then look for core and turbo positions for momentum intraday in the bottom shelf. On the daily squeezes, these are ones that have had strong moves, but where their range in the last day is significantly smaller, 0.7 of their average range. And so their move up, if they make a range stat move and using the previous day's range risk, you get these kinds of R multiples. And I play these as one-day pops. And so I look for things like the symbols that I recognize: Bristol Myers, Amazon, Amgen, the VIX itself, Google, Philip Morris, and XIV, all offering one-day pops. You can see the strong move that we've had here in the S&P over the last 30 days, the positive slope of the 30. Still not exceptional yet, but notice that the parabolic, or the polynomial one, has accelerated, and so we're getting the beginnings of a move to pull away from the long-term gains. We're still just near historical averages over the last 180 days, though, which is this black line. And so there is still room for this to grow 1 or even 2 standard deviations. This is where it was at the peak of the Trump bounce. So there's still a 2 SD move in volatility available here in terms of the slope of the 30. And so that's where the estimate for 5 to 8% potential gain is. Now, we are already testing the top levels of the percent stretch compared to the 200. But since we're only 7 or 8% away, and the historical greatest period has been over 20, this is still an area again where a 5 to 8% move on the upside is not irrational. And that's everything that I want to cover from this weekend report. I'll just rotate through these quickly for you. If you want to stop and look at these, that's fine. I would just say notice that all of the usual suspects, when they're in the white, then that means that they're in positive holdings over 40, 20, 10, and 5 days. And Latin America, Cliff Natural Resources, their Z-scores are strong. And so I'm looking for more out of Latin America. It's put in a nice base and starting to recover. Looking at the slopes of the three regression lines, the 10, the 30, and the 90. See, the 90 is still growing. It's out of the normal channel. Still room for that to go. It's been quite a nice move. The upper edge of the river in green has held as a nice strong support level, and that's been pretty favorable. It didn't fail like it did over in here, and so while I'm sensitive to the 1 day or 2 day sell-offs, I'm still prepared to engage on the long side. So that's everything I want to cover tonight. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.